Okay, good morning, afternoon, and evening, ladies and gentlemen. My name is Midori Paxton, and I'm heading the ecosystem and biodiversity work at UNDP. And a very warm welcome to this second day of the Finance for Nature Global Series. Today, we have one simple yet complicated question. How can disclosure of nature-related financial risk open the door to sustainable financing? Many of us saw the World Economic Forum's report back in January, the Global Risks Report and Nature Rising Report. The message was very, very clear. Loss of biodiversity is a top-ranked risk facing businesses and human society, and half of the global GDP is dependent on nature. And the most vivid example imaginable to illustrate these findings came just after these reports were released, unfortunately in the form of COVID-19. And the whole world, including yourselves and myself, have been seeing it, feeling it at first hand. Until this year, who would have imagined this tiny little zoonotic virus jumping from nature could cause a global health crisis of this magnitude and also causing the worst recession since the Great Depression in the 1930s? And how we can safeguard nature, which supports achievement of at least 50% of the Sustainable Development Goals, or SDGs, so that we can better control and contain future pandemics, so that we can maintain healthy population of pollinators and secure water supplies, and also safeguard the very foundation of our livelihood, our jobs, and our futures. And one thing we must do for this is to correct the market failure and redirect global financing from destroying nature to nature positive. We need to change the current system, which sees many businesses and investors knowingly or perhaps unknowingly investing their money into actually destroying nature, which is a very base of their investment as well. So it really doesn't make sense to anybody. So for this, the power of financial institutions is immense. So we are very happy today to have many finance sector partners with us who are already doing a lot of work on measuring climate or nature-related financial risks. So let us hear what they have to say. So now, if you can put slide up, let us look at the overview of today's session. So after the welcome segment, we have a quick poll, audience poll, and then followed by a keynote address. And then that will be followed by a panel discussion, and we will ensure to have ample time for audience interaction in the form of Q&A session. So now, without further ado, it is my honor to introduce Ms. Elizabeth Mrema to provide an official welcome. Elizabeth, as many of you know, is the Executive Secretary of the Convention on Biological Diversity, or CBD. With her environmental law and policymaking background, with over 20 years of experience with UNEP and various wildlife-related conventions and agreements, and with the government of Tanzania, she has brought a powerful new force and insight into the convention discussion, and she's taking strong leadership in achieving the ambitious post-2020 global biodiversity framework. Elizabeth, thank you so much for joining us today, and this virtual floor is yours.
Thank you, Midori, for that introduction. I hope I really deserve it. Anyway, Good morning, good afternoon, good evening, wherever all of us are. I'm truly honored to have this opportunity to welcome such a great panel and audience. 2020, to many of us, is still a super year for biodiversity, as had been intended, despite the challenges brought about by COVID-19 pandemic, and one that emanates with a powerful message. What's the message? That human beings, to benefit from nature, it is a prerequisite that our relationship with nature must transmute. Already last year, Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services warned us all about the magnitude of the global loss of biodiversity. Overall, 3/4 or 75% of the terrestrial environment and 2/3 or 66% of the marine environment have been potentially tainted by our human deeds. The economic impact is momentous. Between 1997 to 2011, the world has already lost around $4 to $20 trillion per year in ecosystem services due to land cover change, and 6 to 11 trillion per year from land degradation. Just recently, the World Economic Forum report affirmed that more than 50% of the global GDP, which generates about $44 trillion of economic value, are largely dependent on nature. Because nature is a public good, it is today unfortunately considered free and thus overexploited. The result has been in public cost and private profits. The effect is that nature risk is a non-material in much of financial decision making. Let me give an example. The Dutch Central Bank, in its report last month, estimates that Dutch financial institutions worldwide have about 510 billion euros in exposure, which is about 36% of their total assets, to companies with high dependence on one or more ecosystem services. This clearly shows that, considering nature in its equation, the financial sector can be a critical enabler of transformative improvements in economies and markets and contribute positively to halting biodiversity loss. The sector is already scaling up activities on climate change, but it needs to look beyond carbon. To avoid risks and find new opportunities, it has to examine both financial dependencies and impacts, not just on climate, but also on nature assets and services that are provided to the business sectors it invests in and lends to, which if lost at scale, will destabilize the global economy. And it has also to report on its actions. We know that biodiversity was seen to be more complicated than climate change. Tools and data were perceived not to have been sufficiently developed. However, we are delighted that currently many initiatives are emerging in the financial sector that address these concerns. Several organizations are already developing tools, data, and financial mechanisms to address the situation. Delighted that something is happening, but there is need to raise the ambition. Nature-related disclosure will enhance the role of the private sector in mobilizing adequate finance and actions for the successful implementation of an ambitious post-2020 global biodiversity framework under development. For instance, work is currently underway with the Task Force on Nature-related Financial Disclosure, and we will need to make an urgent progress on this. The topic that is before us today for discussion is thus very well timed. We want the task force outcomes to contribute to the global framework and its long-term approach on mainstreaming. We will need to channel collective leadership to reverse nature loss and create inclusive nature development pathways and achieve the Convention's vision of living in harmony with nature. It is now my pleasure and great honor to introduce Right Honorable Lord Zach Goldsmith, UK Minister of State for the Pacific, International Environment, Climate and Forest and Animal Welfare, who will explain to us why nature is more important than just climate change considered on its own. I wish you all a great event and welcome His Lordship, the Minister.
Thank you so much for that introduction, and thank you for those inspiring words as well. It is a real honor to be able to join you today, and I hope everyone taking part is safe and well. It's impossible to begin a speech nowadays without mentioning COVID-19. It has had such a profound impact on the world, and its effects, without any doubt, are going to be felt very deeply for many years to come. But in real terms, it is nevertheless just one symptom of our dysfunctional relationship with the natural world. And we know that if we don't act now to fundamentally reset how we treat the natural world, far worse is to come. Because the fact remains that the world's ecosystems are experiencing unprecedented decline. Around 1 million species face extinction, many within decades. We lose around 30 football pitches of forest every year on average. Our oceans are being choked up with plastic. Its fish stocks are being exhausted at an extraordinary rate. Now, during the global lockdown, we saw a temporary downward trajectory in relation to greenhouse gas emissions, but there was very little relief for nature. In the first 4 months of 2020, we're told deforestation in the Amazon rainforest was 50% higher than the same period last year. And there are many other depressing and similar examples. We're undermining our very foundations, and it makes as little sense ecologically as it does economically. Because, and it shouldn't really need saying, but sometimes it does, we depend completely, all of us, on the world around us. And this relentless, rapid loss of nature is therefore it's a biodiversity tragedy in and of itself, but it's also a human tragedy, given the very direct dependence on all the free services nature provides, the world's poorest people in particular. And without serious changes, it poses major risks across the board, including, of course, and the topic we're here to talk about today, in boardrooms. For the first time in its 15-year history, the top 5 places of the World Economic Forum's Global Risk Report were filled by environmental risks. And the WEF tell us that over half the world's economic output is significantly dependent on the services that nature provides. And in truth, of course, we all depend entirely for everything on the natural world. And a landmark study released in June by the Dutch Central Bank found that Dutch financial institutions alone have 510 billion euros of exposure to nature-related risks. And we're told that the annual cost to the world economy from the loss of nature will reach around $10 trillion by 2050. But one of the barriers that prevents action on a scale that matches the scale of the crisis is that so much of what nature provides us is simply not valued. And so much of the destruction of nature that we're involved in and many times responsible for is simply not counted as a cost. You take the Amazon, for instance, it's critically important on so many levels for human survival. We haven't even begun to understand the full complexity of the dependence that we have on the Amazon. But nevertheless, it's worth more dead than alive. Today, financial incentives that destroy forests outstrip those in favor of their protection by around 40 to 1, probably more than that. There is virtually no understanding about how nature-related risks are connected to our pension funds, our banks, or insurers. And the same could have been said of climate risk only a few years ago, but that has been addressed through the creation of the Task Force on Climate-Related Financial Disclosure, chaired by Michael Bloomberg, championed by Mark Carney. Well, we need the same global effort for nature. Natural systems are vastly more complex than measuring carbon, and as a result, the finance sector struggles to understand it. We all do. In addition, and unlike for carbon, companies do not report their dependence on or impacts on nature. It's true that the Task Force on Climate-Related Financial Disclosure includes some data on nature, but that's only when it's relevant to climate change, and nature-related risks, as we've just heard, go far beyond climate alone. For example, the risk of flooding increases dramatically with the loss of wetlands and the removal of trees and forests. Food production depends completely on the healthy soils that we are currently despoiling. As co-host of the next climate COP, the government's focus will naturally be on clean energy, zero emissions vehicles, finance, adaptation and resilience and so on, but at its core will be a major emphasis on nature. So we recognize that you cannot solve climate change without also restoring and protecting nature on a massive scale. We know that these two crises are inextricably linked. They are in effect one crisis. So we will be focusing on increasing the amount of climate finance that is invested in nature-based solutions, currently a measly and inexplicable 3% of total climate finance. We want to ensure that when we recover our economies, as we all must, that we build back greener and better. Governments around the world have already committed $9 trillion to recovery, and how we choose to spend those funds will have ramifications for decades to come. We'll be focusing on tackling head-on the perverse incentives that destroy the natural world. As an example is the top 50 food-producing countries dish out around $700 billion a year, every year, on land use subsidies, often destructive land use. We need to see a shift in that. And we're going to concentrate on mobilizing the private sector to transition from being part of the problem to being part of the solution. And that's why the UK government is working with international partners to create a market-led task force for nature-related financial disclosures. It will complement the work that already exists for climate-related risk, and it will give investors, lenders, and insurers a more honest and complete picture of the environmental risks that they are exposed to. A working group of financial institutions, governments and regulators from around the world have been brought together by the UN, Global Canopy and WWF, and I thank them all for the work they're doing, and it will officially launch in the autumn. And the hope is that the task force will begin developing a standardized reporting framework for use in 2022. We know that to speak authoritatively on the international stage, we need to get our own house in order. So we've committed to doubling our international climate finance to 11.6 billion. Even more importantly, I believe, with much of the uplift being invested in nature-based solution. We've legislated domestically to be net zero emitters by 2050, the first industrial country, I believe, to do so. We're mandating biodiversity net gain for new housing developments. We're planting trees on 30,000 hectares of land per year by 2025. A commitment was in our manifesto. We're introducing a landmark environment bill to tackle air and water quality, biodiversity loss, waste, and much more besides. But we know that we can't deliver change on our own, and that's why we are committed to building alliances of countries and businesses that are willing to go much further, coalitions of the willing, of the enthusiasts, on targets to protect land and sea, on supply chains, which need to be cleared up in so many different ways, on land use subsidies, on commitments to net zero emissions, and to dramatically increase support for nature-based solutions to the major challenges we face, including, of course, climate change. This is the moment for a seismic shift. It's the moment for a reset of our relationship with the natural world. Coronavirus has ripped up and changed the rules completely. And the UK will do everything we can to help ramp things up. And we look forward to working with many of you on this call today to make that happen. So thank you so much for inviting me along today. Thank you for all the work that you have done and will do. And I hope the remainder of this discussion will be fruitful. Thank you.
Thank you, Minister Goldsmith, for the powerful remarks and championing the global environmental discourse and initiative for redirecting financial flows for nature. I fully agree that we are facing the dual crisis of climate and nature crisis. So in fact, they are one crisis, the planetary crisis. And we need to tackle them in an integrated manner, and we need to create a win-win situation for finance sector and also for people and the planet. And thank you also informing us about the exciting development of the formation of the Informal Working Group led by financial institutions on nature-related financial disclosure. We very much appreciate your leadership and strong commitments of the UK government for stepping up support for nature-based solutions for climate and SDGs. So before going into a panel discussion, maybe we can do a quick audience poll. We have one question for you. So what's the result? Ah, wow, 89%, yes. It's rather exciting to see that majority of the audience thinks it is possibly a game changer. And for those who, 11% who are skeptical, maybe your opinion might be changed by the end of this session. So now it is my privilege to introduce Andrew Mitchell, who will be moderating the panel discussion. So Andrew is an international thought leader on forest issues, climate change, and financing natural capital. He is a founder and senior advisor to Global Canopy and Natural Capital Finance Alliance. He has an amazing over 40 years of experience in this field, you know, engaged in research and advocacy and creation of tools and mechanisms for all sorts of things, increasing financing for forests, and now, very most recently, focusing on also championing redirecting financial flow from negative to nature positive. So now, Andrew, the floor is yours to take us through the rest of the session. Thank you very much.
Well, thank you, Midori, for all those very kind words of introduction. We've got a big task ahead of us, haven't we, everyone? You heard what Midori said at the beginning. This is a simple question, but with a very complicated answer. How do we begin to come to terms with nature-related risk in the financial system? And look at this beautiful picture behind me here, taken by my son off the coast of Iceland. It looks beautiful, doesn't it? But if you look closely, it doesn't look like there's anything alive in there. No fish swimming around. Of course, there are lots of small plankton and things, but it's almost gin clear water. It might look very beautiful, but it could represent a dead world. And that's not the sort of world that we want, is it? And so our task today is to hear from a whole range of experts working in different sectors across asset management, banks, the International Finance Institute, and people who make tools, insurance, all these things to try and grapple with this question of nature-related risk. I think you heard what the Minister said. It's a moment for a reset of our relationship with nature. So that's what we're going to explore over the next hour with our experts. And so what I'm going to do is just introduce them to you so they don't have to introduce themselves when we get to them. So first up is Adam Kanza. Adam is head of Stewardship Americas at BNP Paribas, a very big French bank, global bank, and he leads the firm's stewardship activities in the region, including direct corporate engagement, working with policymakers on key issues relating to sustainable finance and investment. So welcome, Adam. We also got Sonia Gibbs, who heads the Sustainable Finance Working Group at the Institute of International Finance. Sonia's research work covers global debt and sovereign debt, policy issues, financial stability risks, sustainable finance and capital markets. You've got a pretty full plate, Sonia, haven't you? And also development in emerging and frontier markets. So it'd be very interesting to hear what Sonia has to say. Bas Rutte from Rabobank, who's Director of Sustainability. Rabobank, a big Dutch bank, lends a lot into the agricultural sector. And Bas is Director of Sustainability and responsible for their sustainability strategy, sustainability policy frameworks, reporting, and so on within the Rabobank group. And we also have Rowan Douglas. You can see that down at the bottom of your screen from Willis Towers Watson. Rowan is head of the Climate Resilience Hub at Willis Towers Watson, supporting the management, regulation and financing of risks from climate, terror, cyber and other perils. So he'll be able to give us something of an insurance perspective on this question. And finally, Mark Kember. Mark Kember is CEO of Climate Advisors UK, who've helped to put all these sessions together, and is managing director of Orbitas, a new centre of excellence assessing climate transition risks in the tropical commodity sector. And we'll be able to tell us a bit about some of the tools that are emerging to help us screen portfolios for their risks and dependencies on nature. And it's actually, I'll just make a point about risks and dependencies, because a lot of the time we always think about impact that money might have on nature. Now that might be your money that you put in a bank, or it might be your money you put in a pension fund. What we tend to think of is we sort of forget it, don't we? We've been slightly disassociated from our money. You put it in the bank, your paycheck goes in every month, and you take some money out. As long as you're happy it's there, it's fine. But you don't necessarily think what the bank is doing with your money. Same with a pension fund. You might be putting money in for 40 or 50 years before it pays out. But do you ever ask the question, what's the point of my pension fund if it pays out into a dead planet? So we're going to have to rethink the way the movement of money works, because I believe we don't change the movement of money, we'll finance ourselves into extinction. And it's a pretty shocking thought, isn't it? So let's explore some of these themes with our experts here. What I'm going to do is ask each of them to make a small statement about what they're doing in their own business and how they see it. And then we'll have a couple of questions. We'll do that with everyone. And then we're going to come to the audience. And there's quite a lot of you, so we'll pick up some of your questions. So feel free to use the chat function to post your questions, and I'll try to get to some of them at the end. So Adam, may I come to you as Head of Stewardship at BNP Paribas in the Americas? Would you like to tell us what's been going on, what your perspective is on this issue? Adam.
Sure, thank you very much. It's a real honor to be with you, and what an important conversation. I wanted to talk for a few minutes, really in response to the question that everyone just answered about disclosure and what disclosure can do, and in particular, disclosures that help steer the capital markets toward the protection of biodiversity. And I think to answer that question, we really have to pose a much larger question, which is life on Earth material? In other words, does the preservation of life matter to investors? If we're speaking about using disclosure to open the door to sustainable financing, then we really need to provide disclosures that are meaningful to investors. And I have to say, investors are very late to the game, but things are changing. Back in March, my firm worked with AXA, Morova, and Sycamore on a request to research providers to develop tools to help us incorporate biodiversity into our investment decisions. We followed that up with a statement that was supported by investors managing $6.5 trillion. And in part, the statement said, as investors, we recognize a need to protect biodiversity for future generations, because we cannot generate value for our clients without a healthy biosphere. Last year, investors managing $16 trillion issued a statement about the fires in the Amazon. So awareness is changing rapidly. It's rising up our agenda very quickly, but it's still far behind in terms of awareness on climate change, for example. And that took a long time, as you know, to make it onto investors' agenda. So awareness really is the first challenge. The second challenge, though, is to get investors who are awakened to the size of the risk to grapple with the true nature of the risk. The key risk to measure and manage is not how biodiversity loss affects our portfolios. That's critically important. But the key risk is the collapse of nature itself, which is underway. This is an unhedgeable risk of unprecedented size. And risk reporting that's focused solely on risks to issuers or portfolios may not translate to reduction of systemic risk. So in a sense, it misses the forest for the trees. If all we do is seek to hedge or ring fence these risks, then we really haven't understood what we're up against. Properly understood, you cannot preserve shareholder value without preserving biodiversity. There's a significant difference between protecting the financial system from ecosystem collapse and protecting the biosphere from the financial system. If we don't focus on the latter, we risk losing both. Time is tight. We need to effect a mind shift. We need to develop metrics and reporting frameworks, and we need to implement all at the same time. And if that's not complicated enough, it's not just a question of recognizing what a systemic risk looks like and how to deal with it. It's also how the systemic risk intersects with the other systemic risks we're dealing with, such as climate change and inequality. So it's also important to remember, I think, that reporting frameworks and metrics are not neutral. So at the outset, we have to ask, what type of risk do they measure, and what behavior are they seeking to incentivize? So what should this disclosure look like? We're very pleased to be a member of the working group for the Task Force for Nature-Related Financial Disclosures. And that work is just starting. So I should probably say that these are really my own views. But I think a framework, we really need to see a 360-degree view of risk, meaning that we need risk to the issuer, risk to the individual company. We also need that company's contribution to systemic risk, their impacts on biodiversity. This is the double materiality concept that the EU has been speaking about, which I think should help incentivize this. But I think it's fair to note that those concepts, that impact to nature, that external impact, is really alien to US securities regulation and to US conceptions of fiduciary duty. So we have some work to do there. Also important to recognize that impacts to nature and dependencies on ecosystem services will vary by industry and sub-industry. So we're going to need different indicators to address different challenges within each industry. It's also important to recognize that there's different use cases for the disclosure. There's portfolio management and there's stewardship. Just to cite two that are within the asset management industry. KPIs that are used in rating securities, used in portfolio management, are going to be different for equities than for sovereign debt or for other fixed income securities. They're going to be different from the indicators that I'm going to need in my function in stewardship. I'm going to need information on governance, on policies, on goals and benchmarks for measuring progress. So we'll need a disclosure framework that measures process as well as performance. The companies themselves will need different tools to evaluate their footprint. And those tools are going to be different than the tools that investors are going to use. We're also going to need aggregate metrics that don't lose local context. It's important to recognize carbon is global, biodiversity is local. So we have substantial work ahead of us and substantial work for companies to prepare this information. It's going to be new to very many companies. Many of the supply chains remain fragmented and opaque, but the right metrics should catalyze the right behavior. So hopefully the 89% or so that said yes, and I'm with them. I think hopefully they're right. Thanks very much.
Thanks very much. Great remarks.
Yeah.
And I wanted to come back to you on the question of materiality, actually, because it's a really interesting concept that a lot of people don't quite understand. I often hear from financial institutions, well, nature is kind of non-material. If I put that in layman's language, it means that you might invest in a palm oil company that can destroy a rainforest and make a lot of palm oil. And the damage costs to the rainforest are not included in the share price of that company. And they certainly don't show up in the cost of the palm oil when it's sold in markets around the world. So from an investor point of view, if you look at a Bloomberg terminal, it'll say buy, because the palm oil companies are very, very profitable. In other words, nature is non-material. In other words, it's an externality in the economic system. And this is really difficult to deal with. So what's your, what is the way to try and get materiality included in financial transactions? You need to unmute yourself, Adam, as well. Maybe
Okay, can you hear me now?
Yeah.
Okay, yeah, that is the real challenge. And I think, we need to build in systems of accountability. So let me give an example for palm oil. So for example, my firm, and I work I'm on the asset management side of the bank, but the bank establishes sectoral policies including sectoral policies for palm oil. So we set standards for ourselves of the kinds of companies that we're willing to invest in and we're willing to finance, and the kinds of companies we're not. And that sits outside of whether or not we think that investment might be financially material. You have to set some limits. Beyond that, beyond simply saying, hey, we're not going to go there because we're concerned about that broader systemic risk, the system itself has been changing rapidly over time. So you have the Roundtable for Sustainable Palm Oil, the RSPO, right? The RSPO establishes a certification system. Then we worked to get corporates like Pepsi and Coca-Cola and all the big names to set policies saying that we will only buy palm oil if it's certified by the RSPO, right? Now, we had a number of years ago a firm called IOI, which was RSPO certified, but was found to not be in compliance with RSPO's certification system. RSPO kicked them out. Their share price dropped by something like 50%. Now, it's not because the value of their palm oil dropped in the market. It's because they no longer have the certification. And we all decided that certification is material. You know, so it's important to recognize that materiality is what we make of it. Materiality is what investors value. If we tell the market that we value long-term sustainability, that we value a stable ecosystem, it can become material, but we have to build that system. You know, and certification is one way of doing it. There's a lot of other ways of doing it, but it's a huge challenge.
Well, good to hear those examples. And BNP, I should say, is one of the first financial institutions that set up a policy for zero deforestation across all its investments and lending. I think it was the first to do that. There's something rather strange going on there, actually, because you're a French bank. If you look at Paris, it's taking a huge leadership on biodiversity and finance. Caisse de Dépôt, yourselves, AXA, and a bunch of others are all really pushing this agenda from Paris, which is great to see. And generally, Europe is on the case too. The taxonomy that the EU is looking at, the non-reporting financial directive.
Right.
What's it like in the US? Are you getting the same attention there?
Yeah, I have this very interesting role of working for a French institution out of New York. It's quite different. What I actually hear a lot is, oh yes, well, that's European, you know, as if the world is so dramatically different. When I talk to American oil and gas companies about some of the things that European oil and gas companies are doing, that's the first thing I hear. Well, you know, they're European. It is dramatically different. These issues, though,
is it a regulatory thing that's driving the difference, or a different way that things are calculated?
Well, I think there's some significant cultural differences. I think that's one difference. I would say, though, that sustainability is rising on the agenda quickly. There isn't a large financial institution in the United States that I can think of that doesn't have some sort of sustainability function or some sort of ESG function at least within asset management. That doesn't mean they're exactly where I would like them to be, but they're moving rapidly. And you're seeing headlines, you know, on a weekly basis about large U.S. financial institutions that are making new commitments on sustainability. So it's coming. The thing to keep in mind, though, is that materiality question. The financial materiality piece is really front and center for American investors in a way that it's not always, I think it's thought of much more broadly in Europe. The European investors tend to think from a more systemic focus. And that's so critical to this conversation about biodiversity, because we're talking about preserving the systems that allow us to do what we do. You know, so, I mean, as fiduciaries, we have an obligation to fix a system that is not going to allow us to deliver returns to our clients 20, 30 years into the future. You have to take a step back and look at it from a bigger, from that perspective. In the US, there's lots of very small asset management groups, the socially responsible investment groups that have been working on this for decades, you know, and have been leaders on this for decades. And that's actually where my career began. But it's a large financial institution. It's taken quite some time to get there.
Well, let's move on to Sonia. Sonia, you're working for the Institute of International Finance. This was an organization set up in the 80s to deal with debt, big debt. We're now back in the age of big debt. In fact, the debt to GDP ratio is not looking at all well. But you head up a sustainable finance working group in the IFI. So can you tell us a bit about the sort of work that group is doing and a bit about the role of the IFI in all this debate about disclosure?
Thank you very much for inviting us to join this panel. I got to say, you know, one thing, just about all of our 450 members, and that's across banks and asset managers, pension funds, and so on, what they all have in common, I think, is a mandate to scale up their work on sustainability. And of course, as we've discussed until recently, climate risk has dominated the agenda. You can take it as a given that when Mark Carney says a climate risk is financial risk, that the financial sector is listening. But as you and Adam have both noted, these broader environmental and natural capital risks can also translate to financial risk. So maybe we need Mark Carney to extend his umbrella more broadly. You know, and I think it's fair to say that in principle, many would agree that we need a global framework out there on nature-related financial disclosure. But there are, of course, going to be practical challenges, as there were for the TCFD. We got to take stock what initiatives are already out there on biodiversity or natural capital markets. We need to have clear goals for nature-related disclosure and how they're going to help assess and price natural capital risks and externalities. We need to find alignment on approach because fragmentation, as we've learned from the climate agenda, really works against scaling up finance, and we don't want that to happen in the case of environmental finance. And we need a way to measure progress. How do we ensure that disclosing natural capital risks is really influencing financial market practices? So how do we promote comparability in disclosures, as well as the underlying data, definitions, taxonomy? So, you know, bypassing the greenwashing risks that have troubled climate finance. I think, you know, a lot of financial firms are struggling with the scope of what needs to be disclosed. So what are the exam questions that we're trying to pose here? What is material in terms of these risks? So for example, for natural capital, are we trying to price economic inputs that might or might not be currently priced? So something like goodwill in accounting terms, do we need to kind of redefine things here? For biodiversity, do we want to measure the impact financial firms have on ecosystems, including, you know, via their global lending and investment activity? So how do we assess the financial risks, for example, of habitat encroachment and increased contact with wildlife? And how does that feed into the risk of pandemics, which is very, very clearly financial risk? The bottom line, I think it's fair to say that nature needs to be embedded firmly into classic macroeconomic analysis. And you're starting to see lots of people work on this type of issue, because macroanalysis is obviously the foundation of investment decision-making, whether that's valuing cash flows or assigning sovereign bond ratings. And to do all this, you need a framework. You need a framework for nature-related disclosures. So building on the TCFD model, this could include nature accounting systems as part of disclosure. And if you think that's easy, you know, think again. You need a lens for both mitigation and adaptation financing of natural capital and biodiversity. You need tools, of course, as Adam mentioned, to measure how well lending and investment portfolios are aligned with natural capital and biodiversity goals. You could maybe think about something like a GHG protocol for nature, but instead of scope 3 emissions, you could be scope 3 depletions, you know? So if a loan is financing a cattle ranch to clear Amazon forests for grazing, that natural capital loss needs to be measured, recorded, and disclosed. And so ultimately, we need a way to price natural capital and biodiversity risks in sovereign and corporate debt markets, because that's the end game here with finance. For example, a country that relies heavily on soy and beef exports runs a real risk of depleting natural capital. That's an economic loss, and therefore it's a credit risk that should be accounted for and is not currently being accounted for. And finally, you know, it's important to look at the regulatory and policy landscape. And as everybody knows, we have started to see real progress in terms of climate risk disclosures from financial standard setters, leadership coalitions, and so on, the NGFS, the Ball Committee, the FSB. And while the EU is clearly taking the lead, I think it's worth noting that in the US, the debate could really change out of all recognition if the election goes to Joe Biden in November. And here I just wanted to highlight the Biden-Sanders, so reference to Bernie Sanders, unity group on climate science and environmental justice, which has a clear platform of reversing the Trump administration's dangerous and destructive rollbacks of environmental protections. So it's worth noting that in Joe Biden's planned day one executive orders, which are quite powerful tools, as we've discovered from President Trump, these executive orders include climate risk disclosure requirements for public companies as part of a broad US catch-up plan on climate and environmental issues. So how can the financial sector help? We can build out a wide range of products to finance the transition, including investment in nature and biodiversity resilience. And as a model for this, I think social bond issuance has absolutely surged during this pandemic. In the sovereign and corporate debt markets, we're seeing more reference to tools like debt for nature swaps, mitigation and conservation banking, biodiversity offsets. I mean, none of this landscape is perfect, but the toolkit really needs to be built out. I wanted to mention an interesting note in the Argentina debt restructuring. Now, you mentioned global debt, and I think that's just going to be dominating the next several years, because the consequences of slower global growth and the pandemic are going to bring all these debt issues into focus. And it's important to not let it all be resolved without reference to environmental concerns. So I wanted to point out that in the Argentina debt restructuring, considerations being given to building in conditionality to address environmental damage from soy production, just as an example, to Adam's point about investors' interest in long-term sustainability. And finally, I think, the financial sector can be proactive in seeking ways to measure and report natural capital and biodiversity risks on a consistent and comparable basis, which is really important, because it's not, to use the TCFD language, it's not decision useful if it's not consistent and comparable disclosure. And we can work closely with our financial sector regulators and policymakers to incorporate nature and biodiversity risk into the work that's already being done on disclosure risk analysis and building back better. So I'll leave it at that.
Sonia, thanks so much for a very interesting sweep across the issues there. And I think, debt, big debt now, pandemic has caused it. Do you think Treasury departments are getting the message that this is nature-related risk at work?
I think if we're thinking about the borrowing countries that are struggling with debt levels, and some of these are in very poor and vulnerable parts of the world, I think that knowledge is there, and that there's great, commitment to and interest in trying to work on these problems. But at the same time, sorry, a bit of feedback here. At the same time, the immediate issues they have to address are so pressing that there's a risk that, one can say nature can wait. And I've heard you say a number of times that nature simply cannot wait. So it's very important that both the policymakers, the international financial institutions, private sector help borrowing countries in debt treatments, whether that's debt service suspension or debt restructuring, whatever it is, help ensure, that natural capital considerations are not left out of the equation.
And let's just talk about, you mentioned the task force on climate-related financial risk set up by Mark Carney and Michael Bloomberg. And that, I think, is widely regarded as being pretty successful. And indeed, with the task force on nature that we're talking about, we use that as a guide, but we're not going to be constrained by it, because there are some who feel that it's still a bit of a tick box exercise. It's raised awareness, but how many decisions have actually changed within financial institutions because of the fact that they're using the framework? Do you think it's too early to say, or do you think it's going to work?
I think, at the end of the day, it's important to remember that we're tackling a really difficult task of channeling private sector behavior in the way that we want it to go in support of climate and environmental finance, when there's no overarching global framework to make that happen from a mandatory top-down sense, right? So you've got to rely on sort of bottom-up initiatives, and then chart progress of building this in, of hardwiring it in to the regulatory framework. And I think that's the case both for the climate and it will ultimately be for natural capital as well. But I think you're so right, and it's such an important thing to do, to build out this task force now, to bring these issues to the attention of financial firms when they're already working on the TCFD work to take advantage of that structure and momentum that's already in place?
Well, I have been encouraged by the interest shown in the financial sector. I mean, I guess I've been at this 40 years, and just in the last 18 months, there's been more progress and interest in the financial sector than I've seen in decades. So something has changed. I don't quite know what it is, whether COVID this year, plastics last year. There is much more momentum around this. So this is something really exciting for your institute to capitalize on. What can you do to bring the idea of nature-related disclosure to your members and encourage them to participate?
So I think one thing that we've developed is a very clear platform for outreach to our members. And these are across geographies, so including about half our members are in emerging markets, which are, of course, a really important constituency, and their voice is not always heard properly in these debates. So we've got the platform. We are actually, incorporating ourselves, sustainability across all of our different departments, whether that's regulatory advocacy or events or even economic analysis. So, I mean, it makes a big difference if you get to work and use the platform that you have to amplify these messages. And that's very much what we intend to do.
Well, Sonia, you made some interesting remarks about the political context within America, of course, and with a Biden-Trump choice. And it seems clear that if we want to support nature and climate, then Biden is the one to go for. But there's also a north-south element as well, because a lot of the natural capital the world has is actually in emerging markets, in developing countries, who think very differently about these things to perhaps the north. Now, sorry if we can't connect with you, but I think we'll go through to Rowan now and see if something can be sorted out in a few minutes, because we'd really love to hear your remarks. Rowan, well, I don't know what you know about emerging markets, but you know a lot about risk, because you're involved in the insurance business. And I've always thought that the insurance business was kind of ahead of the game on a lot of these issues, because you're picking up the bill for big storms and other things caused by climate change. So tell us a little bit about your perspectives from Willis Towers Watson.
Well, many thanks, Andrew. Can you hear me loud and clearly?
Yes, we can.
Wonderful, thank you. And yes, well, actually, we do quite a bit of work in emerging markets as insurers, reinsurers, and lucky enough to be involved in the insurance of ecosystems in the Pacific Islands, in the Caribbean, and in Africa as well. So we'll be happy, Andrew, to touch on some of those themes. Of course, we all hope we can get back online very, very quickly. But yeah, I'd like to pick up on a couple of themes that Adam and Sonia raised and sort of build on that. So I completely sort of understand and agree with Adam's observation that we've got to, in some senses, move beyond the individual asset-based sort of disclosure requirement to understand the systemic dependency that finance has on ecosystems and the environment. Certainly agree with that, but I also recognise that at this stage, at least, we're also going to have to deal with the individual sort of micro level, entity by entity, because until we can build it up from that level, as well as top down, I think it's going to be challenging for materiality to be understood by the financial system. So. And to Sonia's observation that really to make this count, we've got to align biodiversity and ecosystem related disclosure with mainstream disclosure. And I couldn't agree more with that. And so while I know we want to create some clear blue water between the work being done on climate at the moment and the work being done on biodiversity and nature, I think in reality, we've got to align these things as much as possible, partly because I think some of the methodologies are similar, but also because I think the financial sector is dealing with a little bit of regulatory sort of stress in terms of the amount of new requirements coming down the pipelines. We need as much as possible to make things align. So that being said, I just want to perhaps finish with a few key examples and where we can align things. So because insurers deal with, if you like, real climate risk in terms of the physical risk of extreme weather and other climate-related risks affecting populations or exposed assets. In the last 5 years or so, there's been tremendous understanding of the role that ecosystems and nature plays in enabling the resilience and protecting assets and populations from increasing risk. And actually, this deals with one of the challenges we have with nature around valuing it, putting a price on it, when often it's not owned by anybody, or often there's no income stream. And actually, it's the physical side of climate risk disclosure that perhaps provides the signpost what we need to do with pure nature-based disclosure. And that is when entities need to disclose their potential risk of events that can happen, it requires them to highlight the costs if certain assets were not in place. So the classic example is the coral reef or the mangrove, is protecting many coastal communities, both developed and emerging, from the impacts of storm surge and other risks from climate. And it's protecting livelihoods in terms of fisherfolk, it's protecting tourism, it's protecting obviously physical assets. And obviously those natural-based assets can be diminished or even destroyed. And the risk of that then increases the contingent liability that entities have for in climate events. And that can be valued. And because this requirement to disclose climate risk, which then can easily be extended to require entities to disclose their risk of a diminution of nature-based assets, that suddenly becomes a contingent liability. And that means that entities have an economic interest, if disclosure is required, to actually invest in their maintenance or their repair or their protection against risk. And we're seeing this beginning to happen in the insurance field, where because you don't need to own an asset to have an insurable interest in it, we're working with many other partners in the industry to begin to insure nature-based assets against loss. Often this is being funded at the initial stages by development banks or NGOs or governments in the public sector. But we're beginning to see that as entities are required to disclose their climate risk, they now have an economic interest, and we're beginning to see commercial entities enter the fray in funding the insurance and protection of natural assets which they do not own. This, I think, is the beginning of a really important step forward. So would be keen to build on the physical climate risk work that's underway to expand those types of approaches to enable entities to disclose other pure nature-based dependencies. And I think that is a very promising area for addressing some of the challenges that Adam and Sonia have raised in their earlier interventions. Over.
Rowan, thank you very much. A very interesting remarks. I was talking to Swiss Re earlier on this week,
yeah.
And they mentioned that they'd come up with a sort of new kind of cover for protecting a coral reef. An extraordinary idea. You can think of insurance, you can take out insurance for your car, take out insurance for your house because you don't want it to burn down, but this is insuring a coral reef to make sure you look after it. Now, could you see a time in the future where, you know, you might not offer insurance to hotels on coasts if they didn't always take out something to protect their reef as infrastructure that might protect their asset?
Absolutely. You could certainly see a situation where the cost of insurance for the hotel would become closer and closer related to the security of natural assets upon which it depends. So certainly the hotel may be required to disclose the health and resilience of its dependent coral reef, and to show that it's operating or supporting its maintenance. So I can absolutely begin to see the dependency, and just as an example, yes, but to give the audience the example, coral reefs are being insured against bleaching events, being insured against storms and impacts, such that when these events occur, funds are liberated to do a number of things. I didn't realize until quite recently you can actually do things to repair and rebuild coral reefs to increase their sort of speed of regrowth, but also you can literally pay local communities not to fish in the coral reef for a period of time to allow the ecosystem to repair. So all sorts of exciting developments, but perhaps the most exciting one is there's the beginnings of a genuine economic interest being sort of created through this reform of regulation that is actually beginning to take this externality and make it an internal value within entities, and that's very exciting.
I think one of the missing pieces in this nature story is if you are a pension fund and you're investing in a particular company, it might have assets all over the world, but you don't know where they are. You don't know which precise location the hotels might be or a mine might be. So you can't calculate the biodiversity risk because that's very spatially important. It depends on where you are, if you're in a desert or a delta. If you're a mining company, you've got lots of water in the delta and no water in the desert. From an insurance perspective, how do you deal with that lack of availability of data for nature-related risk, in particular things like company locations?
Well, it's interesting you bring that up, Andrew, because I'm a geographer, and I'm glad to say that the insurance sector over the last 20 years has had to employ lots of geographers because we have had to become spatial. So obviously, when you insure your house, you have to give your address and your postcode, and now we basically spend our time looking at maps and GIS systems as much as spreadsheets. What's really exciting is that this revolution in spatial finance, through the climate and now the nature agenda, is beginning to infect the wider financial system, so that actually where assets are located is beginning to become an important component in the wider. It will take time. I think it'll be about 10 years until investment portfolios and other financial sector areas become as spatially sort of classified as insurance has had to become. But it is on the way, and it's actually physical climate risk which has been the driving force. But of course, nature will be able to take advantage of that.
Yeah, but why does it take so long? Companies know where their assets are mostly. Is there some reason why they don't want to release this data?
Well, you'd be surprised in as much as companies up till now have not been required to map a model where their assets are. I mean, it sounds ludicrous, but actually that hasn't been the case. So there's no technical reason why it hasn't been done. It's not necessarily always trivial to bring this material together, but there hasn't actually been the formal requirement for companies to do this. This is beginning to change. It will take time, but I think it's within a decade. I think we'll be in a much stronger position. That's not to say in some higher risk areas and particularly new areas of finance, like the one we're talking about today. While that can't happen more quickly, but across the broader financial system, I think it'll take a while.
Well, very interesting, and maybe insurance can help drive this forward. And I think there is a spatial finance initiative I heard about as well.
That's right. Ben Caldecott at Oxford University is driving the bus very successfully.
Yeah, good. Well, let's go to Bas again and see whether we've solved this connectivity problem. I'm going to go to the last speaker. If you can't get access to it, we will come back just again. We don't want to lose you, Bas, but for those who don't know, I can speak a little bit about what Rabobank has done. They've been a signatory to the Task Force on Nature. It's a huge Dutch bank and has a tremendous amount of exposure in emerging markets. They lend into 19 million hectares, I think, in Brazil alone. And one of the really interesting things that I was going to discuss with Bas was, how can they differentiate lending to farmers that are doing the right thing and make it a bit more expensive for farmers who are doing the wrong thing. And there's a very nice product called Agri3 that they're developing, which is a $1 billion loan facility that's going to do just that. And that can all go up the chain to be disclosed that this particular institution is doing that sort of thing, and the farmers and the big agricultural industries that they're working with, because after all, the reality is that the food system is probably the biggest destroyer of nature on this planet. It's a sad thing to say, but I think we're going to see a big shift from a focus that's been on fossil fuels over the last 15 to 10 years to our food system, which doesn't seem to be very fit for purpose because it's a big emitter. It's causing a lot of destruction of nature, and it's also not making us very well because diabetes is a major bed blocker in hospitals around the world. It's all related to health and diet. So food system's going to come under attack, I think, and also because of new foods like Beyond Meats and those sorts of things. I went into a Dunkin' Donuts in New York before lockdown to have a coffee. I was that desperate and thought I'd come out with a Krispy Kreme, and instead I came out with a Beyond Meat burger. I'd never eaten one like that in my life, and amazingly it tasted pretty similar to a normal hamburger. So look out the food system for these new disruptive technologies, and all of this is going to go into this disclosure process of who's funding what. And we have a massive problem, we've hinted at this earlier, about subsidies, huge subsidies, 700 billion a year going into the food system, which distorts market prices and is often nature negative. Get that concept of what's nature positive and what's nature negative in terms of the flow of money around the world. And the sad thing is that if you took all the money that governments are putting into protecting nature, the amount of subsidies that are going in that are destroying nature or are harmful to nature are 5 times bigger. So even if we doubled all the money that governments were putting into protecting nature, it wouldn't even come close to competing with what subsidies were doing that were nature negative. And what we need to understand all that is good tools, good ways of measuring and metrics. And our next speaker that we're going to come to Mark Kember, is such a specialist. He has been working on these issues for a long time, particularly in the climate arena. And Mark, I wanted you to tell us a bit about this. Let's explore how we measure our way through this disclosure process. Mark, over to you.
Thank you very much, Andrew, and congratulations on the launch of the TNFD, or the pre-launch of the TNFD. I'm not sure exactly how you're framing it. And thanks also to UNDP, UNEP, the Global Ethical Finance Initiative, and of course my colleague at Climate Advisors. I'm going to talk a little bit about climate transition risks in the tropical commodity sector and how that affects deforestation, but I'm going to finalise with a few conclusions about disclosure and the TNFD. Next slide, please. While there has been a huge amount of interest, obviously, on the risks associated with climate impacts themselves and on climate transitions, talking about not only policies, but also changes in consumer and corporate behaviour. There's been a lot of interest in the energy sector and obviously energy sector policy. And we've seen the work the Carbon Tracker have done, a lot of work on carbon bubble, IEA have published. And as we've heard already, and many of you will already know, a lot of disclosure taking place under the TCFD, funding mechanisms and so on and so forth being developed around climate impacts and the energy sector. But very little attention has been paid to forest deforestation and the impacts that deforestation can have on investors' portfolios. And that's not only suggested by the fact that only yesterday, Ceres, as you'll have heard, published their investor guide on deforestation. Fantastic, they've done it, but 10 years after, similar guides came out around other sectors for investors. And we've had institutional investors groups working on climate change for over a decade, nearly 2 decades now in some cases. But again, very little attention paid so far to deforestation, forest, and of course, broader nature. That in the context, of course, that we know that 30% of the climate problem, or 30% of the climate solution, will come from land-based and forest-based activities, and hence the rising interest in nature-based solutions that the Minister referred to earlier, and of course, nature-related risks. Next slide, please. And yet, we can see, as I mentioned, in other sectors, we can also see in the tropical agriculture and forestry sector that climate responses are already disrupting markets. And those are in part climate policies, whether it be carbon pricing, and an interesting study that was published just a few days ago showing that carbon pricing is having an impact. Countries that have carbon pricing are seeing faster rates of emissions falling than those that don't have carbon pricing, and beginning to see changes in industry structure. But it's not only carbon pricing, it's to direct restrictions on access to forested and other natural landscapes, changes in corporate commitments, and we've seen a rise in both financial and non-financial institutions that are making commitments around deforestation. We have the French government who says it won't allow the import of beef, soy and palm that is connected to deforestation from 2030. And we're also seeing, as Andrew just recently mentioned, changes in consumer behavior. Massive rise or rapid rise in vegetarianism and veganism, shift away from meat-based diets. Even those who aren't making vegetarian or vegan commitments are clearly already reducing the amount of meat, beef, pork, chicken that they already eat. These disruptions are potentially very significant, and they're significant not only for the oil and gas sector that we've seen already. You've seen recently BP and Shell writing down the values of their reserves and the impacts that that has on their financial health and that of their investors. But also, we're now going to see similar changes and similar impacts on companies that depend on forests and natural resources directly, as those are affected by climate and other sustainability policies. Move on to the next slide, please. And this is already significant financially, although it hasn't been measured, it's not been widely communicated. 44 financial institutions of those sampled had over $300 million each invested in products that are, or in companies that are linked to deforestation through palm oil. 44 companies, $300 million each at risk. And investors in 13 companies have at least $23 billion at risk, and that's just from currently available data. So this is material, and this is just related to climate responses in the tropical agricultural sector, and in one case, just palm oil alone. So this exposure is significant. It's not being reported yet. And if I can go to the next slide, we can see how, just in schematic terms, how these changes would happen. This is not, as temperature increases rise, there are clearly the physical impacts we've spoken to already. But as we try and shift towards hopefully a 1.5 degree maximum increase in temperature, but even as we go to 2 or 3 degrees, there are going to be increasing climate responses. And each of those will have impacts across the board on companies that are producing tropical commodities, whether that be palm or soy or beef or a range of other tropical commodities, and in particular, those who are investing in them and financing them. Just to take an example, if you've lent money to a palm oil company and used as security for that loan a forest concession that that company has on its balance sheet, hoping to exploit it in the future, as climate policy or other broader sustainability and nature policy comes into play, then there's a significant chance that that concession will no longer be viable for production and effectively becomes a stranded asset. And so, for example, chain reaction research published that found that under the moratorium on deforestation put into place by the Indonesian government, nearly a third of all the concessions that palm oil companies have on their books would become stranded. Stranding of assets is a natural process that takes place with technological change, with policy change, but this is a much more abrupt process of stranding that would normally happen and can be very disruptive if not anticipated. So these policies that will address not only climate change, but biodiversity and nature destruction feed through the system, through companies operating business models, their operating costs, the opportunity costs of the land and the natural resources that they exploit through to the financial system, whether they be lenders or equity investors. And to date, as far as we can see, that is hardly happening at all. And because it isn't happening, and because it isn't being disclosed, it's not yet affecting financial decision making, notwithstanding a few isolated examples where we're seeing change beginning to happen. Next slide, please. So the process that we should see happening, and this is where the disclosure process and that disclosure becomes not a mere box ticking exercise, but actually something that leads to change, is that we see on the left-hand side of the slide at the moment a fairly logical framework of how policies and other actions reduce the forested area available for cultivation. Therefore, tropical soft commodity producers will find that their access to that land is restricted. And therefore, those that are dependent on expansive strategies, that's to say, not improving yields, but rather just expanding the land under cultivation, will see that their business models are adversely affected, that their ability to raise finance should be adversely affected, and the value of the company themselves, if a lot of their value, analogously with the oil and gas sector, is dependent on the concessions that they own, should also be negatively affected. That, of course, in turn, reduces the value of the companies to shareholders and increases risks to lenders. To that point, it's a logical framework. What the disclosure process that we're discussing today and the measurement and assessment of those risks should do is mean that as investors and financiers become aware of these risks, they reward producers who have sustainable and intensive strategies, i.e. increasing productivity, over those who don't invest in productivity, but just look to increased area, which, as we've seen, is likely to be restricted. At Orbitas, we have been using TCFD type approaches, creating scenarios of different kinds of policy and societal responses to look both at, look at the macro level. What do these responses mean in terms of how much the supply and demand for products, supply and demand and costs of the inputs, access to land, where it makes sense to grow soft commodities and where it makes sense to either conserve or restore nature, looking at the micro level. What are the differences between firms and their strategies, and how does that affect their profitability? In other words, how capable are they of adapting to external policy shocks, whether those be climate responses or broader policies to protect the natural environment? And then translating that into financial risks, whether that be free cash flow, value at risk, or other metrics that are used by financial institutions to make capital allocation decisions. And we're in a very early stage of this, working with a range of well-known institutions, looking at the modeling and doing this analysis. But some of the early results suggest, I have to say, fortunately, that those companies that have invested already in R&D, have invested in sustainable yield production, whether that be for cattle, whether it be for palm, whether it be for soy, and those that are not dependent on expanding into currently forested land, will benefit in the future. They'll benefit in a number of ways. For example, take the case of palm oil, which is the highest yielding, most productive oil seed that we have. Under any future climate or sustainable development policy scenario, demand for and production of palm oil is likely to increase. However, that has to take place in a context where there are restrictions on the destruction of nature and forestry. What we've seen is that up to $900 billion a year will be needed to invest in that shift to maintain the outputs of products that are found in 50% of all supermarket goods across the Western world, but also to protect the forest. We need to look at the financial mechanisms that bring those values of the forests to life, whether that be biodiversity, whether it be carbon, and those need to be disclosed so financiers can make the right decisions. And just a final comment to bring this back to the question of TNFD and TCFD. The sort of work we've been doing is responding to TCFD type disclosures, but it's clear that the risks and opportunities to tropical commodity producers will be far greater in both directions if nature is taken into account alongside climate. So if the values of nature that are being lost, or the values of nature that could be gained through strategic investments can be incorporated, then the shift that's available to investors and financiers of tropical soft commodities will be that much greater. So I would just urge Andrew and others who are involved in this, while it's important to think of the two things separately, to think about nature because it's been ignored systemically so far, we mustn't keep two silos. And we must think about how the risks and the opportunities from nature and climate can be incorporated to send an even stronger signal to capital providers.
Well, thank you, Mark. Yes, it's good news actually to hear of the potential overlaps between, in a sense, the philosophy and strategy and even methodologies that are used for climate risk can also map across to nature risk. And indeed, a lot of, as we heard from the minister early on, he said, well, look, you know, nature offers a huge opportunity for mitigating climate risk, but it only gets 3% of the money going into climate. So we need to up that conversation, and then that could map across into other areas to do with nature-related risk. And what do you see, though, as the biggest missing piece here? You've explained how your particular work and tools focusing on commodities causing deforestation, but if you were from a pension fund or from a bank's point of view, what kind of a tool would you be trying to build that would cut across all the sectors? And is there anything out there? Are there a few out there that are doing that, not just in tropical commodities?
I think sort of echo what a couple of other speakers have said before. We need to look at the systemic risks, but we also cannot ignore the sort of the local and micro risks. There have been a number of sort of questions around place-based risks and financial responses. And so it's a bit of a challenge. We want to look at everything systemically. It is very complicated. I mean, Andrew, you and I were speaking the other day that just the quality coverage of data, the kind of data you need makes the sort of looking at everything at the macro level very complicated. So we need to, I don't think there's anything that exists at that level yet, but what we do see, well, there are a number of pieces of research that value, as we've heard some already today, the value of biodiversity, the value of coral reefs. There's a lot of valuation work that's been going on. I was involved in valuation work in the 90s around natural capital accounting. So I think we can bring a number of those approaches together, because what investors or banks need will be able to make is to be able to make decisions based on money, to put it bluntly. And
is part of the problem here. We're dealing, investors tend to look in things like Bloomberg terminals or Refinitiv terminals to get the information they need. And they're based on data that's held by companies. But when you're dealing with nature, the data you want isn't held by companies, so they can't necessarily report it. They're government data sets, they're UN and civil society data sets, and data sets behind paywalls that, we've got to get access to all of that data to fully understand nature risk. Do you agree with that?
I absolutely do. And that's why I think that, there's a move towards making TCFD disclosure mandatory. I think I'm assuming that you are proposing that eventually TNFD data would be mandatory as well. And we need to then have much larger publicly available databases on valuation, not only of sort of the amenity or the public good value of nature, but of nature to the productive process. And I think, again, you, Andrew, involved in the Encore process, looked at how nature plays a productive role across a range of industries, and that needs to be valued too. And it's going to require specialists looking at their fields, but also efforts to integrate those and bring those approaches together. And that's something perhaps we haven't seen in any sector so far.
Well, thank you very much, Mark. I think we've got to move on, and we're closing moving to closing remarks in about 15 minutes or so. And there's one thing I want to do with the audience. This is to engage you. I think what we're going to do now is move over to try and answer some of your questions, and they're coming in from all sorts of sources here. I think there's one which I'd like to pass over to Rowan for the first one here from Corley. it says one on the economic valuation methodology used by insurance companies to put a price or value on coral reefs or nature. Can you tell us a little bit more? Do you know any more about what's the actual methodology people use to try and price these nature assets?
It's actually the way of valuing, in this case, the coral reef is essentially assessing the impact that the loss of that reef would have on dependent assets and communities. So, for example, if you have a coral reef that's protecting effectively a coastal community or city, it's protecting the community against storm surge and other storm-related risks. But also, the coral reef is providing a livelihood for those who depend on it for fishing, and can also be a key attraction in terms of making the place a destination for tourism. So, if that coral reef was damaged via bleaching or by a storm or whatever, it would clearly have a financial impact on the economy. And individual entities, hotels, shops, and others could actually begin to assess what that impact would be. And one of the work we do is to say, if the coral reef didn't exist, it would have this sort of impact, or was damaged, it would have this immediate impact and this sort of enduring impact for a period of time. And people can assess how much value there is in trying to maintain that reef or help to rebuild it, or provide financial respite in the event of an event. So actually the way of evaluating the coral reef is actually to impute the value by the impact it would have negatively if it didn't exist on others. And so that's perhaps a slightly unusual way of valuing things, but in this instance, it's really the magic key. And as we move towards risk disclosure, it's actually the key that's going to unlock the door. So I hope that we happily will, if you Google coral reef insurance or valuation on the internet, I'm sure you can find some good links to that, and we'll make sure we put some stuff on the web in the next day or two if that's of interest. Over.
If there are people interested in the methodological side of this, I would not only we've already heard about Orbitas from Mark, but also there's Encore. If you go to encore.finance, that allows you to screen a whole portfolio for dependency and impact on nature across all sectors, 156 business sectors. And if you want to get down to the detail of individual companies, try taking a look at Impact 360, produced by GIST in India. If you Google Impact 360, you should find that. That's much more specific, right down at a company level, puts its impact down in dollars and cents as well. And they're doing that across lots and lots of companies. Well, of course, if we do this, it might mean that investors move their assets around. So, Adam, I just want to ask you, is there a danger here that if you start to put a value on nature, that sometimes investors might say, well, I'm going to shift to a country or a place where people haven't really done that, and I'm going to put all my investments there and starve investment in the good places? Are we going to see those sort of shifts?
Well, there's all sorts of risks to it. I mean, first, you talk about you do not want to see investors start to boycott countries, right, where there is high biodiversity, significant risk. And you certainly don't want to see shifting assets to environments where there's a lack of regulation. And I think there is a significant risk to that. And I think we already see that, right? I mean, we already see that in how companies source through their supply chains. There's another risk in terms of valuing nature, which is a little bit more abstract though, which is, so let's say that number isn't big enough to protect it. You know, the dollar value isn't significant enough. We are ultimately dealing with a collective action problem here, right? And which is one of the reasons why it hasn't been solved. The risk to an individual company may not be significant enough to generate the activity to protect that natural asset. And the piece that we haven't really talked about here is the role of government. There's only so much that the financial sector is going to be able to do here. We can do a lot, and we need to reorient our activities tremendously, but we really need strong government support here. And part of that is to put guardrails on the system.
Excellent. Well, now I've just heard, see Bas Ruta is back online, and I'm just wondering, Bas, if I could hear you a moment ago, and I wanted to give you an opportunity to speak if we can hear you. So unmute yourself. Can we hear you now, Bas?
I hope you can you?
Yes, excellent. Well,
oh my God, I'm so sorry.
Anyway, we've got you. That's what matters. Look,
That's
we're
true.
in the sort of closing moments of the Q&A, but I think it would be great to hear from you. We might curtail a little bit of the Q&A, but
Sure.
there's so many questions, people can see them on the chat. But would you like to, I mean, you know, we've talked a lot about the movement of money around, you know, you're a big lender. How do you see this disclosure process? It'll have to be fairly short, I'm afraid.
I understand completely. Of course, it's going to be crucial. The TCFD has marked clearly that once you start measuring and you start identifying a systematic way of calculating the exposures, then banks will move, investors will move. So quantifying exposures, quantifying risks and opportunities is definitely a starting point. We are definitely there to help. We are, of course, big in food and agriculture, and as a result, climate is totally relevant to us, but completely interlinked with biodiversity. So what we are currently doing is to set up an activity where we start measuring the climate impact of agriculture worldwide, which is not yet measured properly. And we want to link that to the active participation in the Task Force for Nature-Related Financial Disclosure, so that we can jointly identify the exposures of our clients, but also help solving these issues. And in order to do so, we will also make sure that we start measuring the exposure of our individual farming clients. You said rightly so. We have over 17 million hectares of land in Brazil alone under security. So we want to use the performance of our clients to actually incentivize them to increase their performance, therefore protecting forests from being deforested, but at the same time also enhancing biodiversity on the land of our farmers worldwide, which is a significant area. And we look forward to work with UNDP, UNEP, but also with the other banks to make that work as fast as possible, because we think we can definitely make a difference while cooperating and incentivizing our clients.
Bas, thank you. I mean, incentivization is really interesting. How do you get farmers to do sustainable action as opposed to unsustainable action? Surely you can offer them some incentive through your lending. Can you tell us a bit how you might do that?
Sure. The easy way is to actually measure the performance of a client and incentivize them by lowering the interest rate, which is a very straightforward tool that we use throughout, for instance, our Brazilian clientele. The best performers pay lower rates, but at the same time we work in the supply chains using also the off-takers of our farmers and the large food companies to actually create a better market price for the sustainably produced, yielded farm crops. So the supply chains we use to get a better price for the rightly produced goods, and that also helps to actually create a business case for doing the right thing. I need to say but, because in many of the environments in which we operate, doing it sustainable, producing sustainably is something that takes time, and time is a risk, especially in unstable environments. So what we currently focus strong on is to combine private money and public money in blended finance solutions to de-risk investments in sustainable agriculture. So our Agri3 fund, the one you also mentioned, is an example where we de-risk the investments in long-term farm development. And as a result, we are able in 10 years' time to create the right price for a sustainably produced crop. But until then, we have a de-risking leverage from the public money to make that happen and to make that possible.
Well, thank you, Bas, and thank you also for being signing up to the TNFD. Obviously, you support the idea of nature-related disclosure. I want to just come to Sonia. There's an interesting question here from Jacques Bonnet, who's worked a lot in Brazil, and that's, you know, where do investors go to get sort of, you know, ratings on this? Is there some kind of ESG ratings agency out there that for nature that people can turn to, or would you like to see that sort of thing happen, Sonia? Oh no, I think I forgot. Sonia had to leave early. So would anybody else like to pick up that question? Well, let's say Mark, let's come to you as the final word here. Could you design a sort of ratings agency for nature with some of your tools, or getting together with others to do so?
I think I'll go back to what I said before. I think we need a lot of people bringing lots of different tools, which are then tried and tested. And I think one of the things that being on a panel with a couple of bankers is what we want to do, and I think others too, we want to try things on the ground in practical terms. And I think that'll be the same for TNFD as it will be for climate response risks, transition risks. It's that challenge of, can we create one thing that solves all problems? Probably not, but conceptually it will be helpful to help us understand what policies we need, what frameworks we need, and what regulations we need. But we're still going to be having bottom-up attempts to pull things together. That said, there has been a lot of work being done over the last several decades on natural capital accounting in national accounting. There was work done in the World Bank and elsewhere. There's been work done by universities, and then indices of sustainable welfare and so on and so forth. So maybe we can draw on some of the lessons as well from there, which have tried to integrate different environmental and social impacts into valuation methodologies and see how they can be applied to financial and business risk accounting.
We're going to go to the last word from Bas, because he didn't get a good shout like the rest of you. And so, and then I'm afraid we're out of time. And I do apologize to all those who posted so many interesting questions. They will all be recorded on the chat, and you can see a recording of this event. But we're out of time. We can't answer them all. And I do apologize for that. So Bas, you get the last word, and then we're going to have a summing up from Nigel Topping. Over to you.
Well, people who would like to use you would like to use tools to actually start integrating these types of measurements into their financing or investing practice. I can refer to a paper that will be published shortly, within 1 or 2 weeks, actually under the Biodiversity Working Group of the Dutch Central Bank, the one that's already taken this topic as a central thing in their commitment, in which a number of the tools that banks and financial institutions can use to measure these impacts and to also mitigate those risks will be summarized, including the contact details of the institutions already working with them, in order to join that activity and to work together on solving those issues. So there is a good overview available shortly to actually start working with the banks already applying it. And we definitely welcome you to join us there.
Thank you very much, Bas. Well, I think it's time to hear some closing remarks from Nigel Topping, and then I will round out the end of the event with a few remarks about the next steps on the task force for nature. So I'm going to invite Nigel Topping to say a few words and summarize what we've heard today. Nigel is the UK's high-level climate action champion, appointed by the UK Prime Minister in January 2020. The role of the high-level champions is to strengthen collaboration and drive action from business, investors, organisations, cities and regions on climate change. Prior to that, Nigel was CEO of We Mean Business. So Nigel, let's hear your remarks.
Well, thank you, Andrew. It's great to see you, and thank you to all the organisers for putting on this series of events on such an important topic. I start by saying, 3 cheers for disclosure. Andrew, you and I first met when I was working at the Carbon Disclosure Project and working on introducing water disclosure and then forest disclosure with your help into that platform. So obviously, I don't need convincing on the importance of the sunshine treatment of transparency. Thrilled to see the UK presidency's commitment to that and the news on the Task Force for Nature-related financial disclosure. So thank you to all those of you who've collaborated to get that to the starting blocks and up and running. I think it seems to me very clear that TCFD is going to become mandatory in a growing number of markets. I mean, I think by the time we get to COP, we'll have 5 or 6 significant markets who've made that mandatory, and I'd be confident that TNFD, given those involved in it, I'm sure it will be every bit as high quality, will follow pretty quickly. This conversation is happening at a remarkable time when we're, COVID-19 is still massively negatively impacting health and economies around the world, different phases. It's still very much to peak in some economies, whereas others we hope are past the peak and hope we don't have a second peak. I think it's worth remembering that this was always going to be the decade of delivery. So there was a need for lots of inflection points, and now it's going to be the decade of delivery followed or stimulated or not by COVID recovery packages. So the trillions of dollars being dedicated, and whether or not they tilt towards a future economy which is zero carbon and nature positive is going to be key. There's some really encouraging language and early signs, but a lot more work to be done. I mean, you'll have seen that Canada's included TCFD as a criteria in its green recoveries, and then in the private sector we start to see BlackRock. And you know, everyone talks about Larry Fink's letters, but my favourite Larry Fink moment was about 6 months ago. Christiana Figueres and Tom Carnac were interviewing Oliver Berta, the CEO of Allianz, and asked him what he thought about Larry Fink's latest letter, which made a lot of news. And Oliver Berta laughed and said, welcome to the party, Larry, you're 10 years late. I think quite often asset owners get there much sooner, and asset managers tend to follow. So hopefully that news at BlackRock's, I think, taken 53 companies out and put another 240 on notice because of ESG issues is a good sign of things to come. You know, I'm sure many of you, like me, read with great interest the Future of Nature and Business report, which was just published this week. There's some eye-watering figures in there about the macroeconomic case for investing in nature, notwithstanding some of the challenges some of the speakers talked about in terms of making that a microeconomic case. I mean, that's often the challenge, right? So some of the numbers that I just drew my attention, that tackling the global nature crisis could create 400 million jobs and $10 trillion in business value each year by 2030, whilst also delivering on the environmental and social imperatives of the decade. So it doesn't have to be a trade-off. Expanding protected areas of our planet to 30% results in benefits exceeding costs by factors of more than 5 to 1, and generating additional economic output of 250 billion annually, and that restoring degraded forests generates $7 to $30 in economic benefits for every $1 invested. I know that for some of you those are familiar figures. Andrew, you know, you've been working in this area for a long time, but it's really encouraging to see WEF putting their kind of analytical and institutional weight behind that. And I hope that reports like that, plus the Dasgupta report, which will be coming out, will really securely make the macroeconomic case, because it seems to me one of the most important things we have to overcome is the framing that suggests this is a choice of either we have thriving economies or we have thriving forests, and we can't have both at the same time. We have to overcome that framing, and I've seen that in until recently. I was on the board of the London Pension Fund, and it's one thing I saw was most old school finance leaders still assume there's always a trade-off, and that's why I think putting disclosure and risk at the heart of this conversation is going to be so important. You know, as a high-level champion, I work with my colleague Gonzalo Munoz from Chile, and our job, as you say, is to work with the non-state actors. And we think we first of all need to make sure that all of those actors are agreeing to some of those big targets, like the 30% land and ocean protection, like hundreds of millions of hectares of degraded lands being restored, like doubling the productive land under regenerative agriculture so that we can restore and protect and improve the carbon content of topsoil, and of course ending deforestation in soft commodity supply chains, something that I learned about first from you, really, Andrew, back when you were launching the Forest Disclosure Project. So those are the kind of things that Gonzalo and I, with the Marrakesh Partnership, this large group of NGOs, are working on. I absolutely think that disclosure is at the heart of it. And I'm sure that the TNFD will build on the pioneering work of CDP and CDSB and the Natural Capital Coalition, who've been doing a lot of this, but in a voluntary basis. So I have learned a lot of the lessons of what works and what doesn't work. So just as TCFD built on that heritage. I was really encouraged to hear from some of the speakers about some of the innovations in spatial finance and new forms of insurance for natural capital. The one thing I think is also some of the language talking about some of the discontinuities that we face. Mark talked about the sort of cultural discontinuity of a shift to veganism. Andrew, you talked about the technological discontinuity of a shift to non-meat proteins, and some of you will have seen the report of Rethink X recently, which suggests that half of the ranch lands in America which currently have cows on them will not have cows on them by 2030, because those products will be cheaper, healthier, and more ethical. I do think at the heart of TNFD, it's really important to make sure that there's a really robust thinking about scenarios. I think some weak TCFD implementations have just assumed two scenarios, like bad and worse, in terms of endpoints, and it's really the dynamics of transition which is most important. What the UNPRI have done some great work on calling the inevitable policy response. So the non-linear responses which lead to what Mark was referring to stranded assets. It won't, these transitions tend not to be smooth. They're nearly always exponential, whether it's cultural, technological, or policies. And in that vein, we've seen a massive increase just in the last 12 months of companies embracing the need to get to net zero. And really a year ago it was only a handful. Now it's over 1,000 companies. Every week you're hearing more. This week, Reliance Industries from India, massive diversified industrial, net zero 2035. Just today, Apple committed to net zero at 2030. And of course, in the nature game, then there's some very big names like Nestle, Unilever net zero 2039, Natura net zero 2030, with a big restorative, regenerative element to those plans. So I think they will be pioneers of TNFD. They will welcome it, and they will also welcome, I think, the really important point which Adam was making, that we need policy as well to match that, what we always call the ambition loop. Private sector won't be able to do this on its own, it needs both. So I've learned a lot today. I'm really looking forward to the rest of the series. Thank you to you, Andrew, and the rest of the organisers for that. With Gonzalo and the Marrakesh Partnership, we're updating our work on 1.5 degree pathways, which attempt to lay out in a simple way the main steps which different actors have to make in each sector on the road to a resilient zero carbon economy. I can assure you we'll be building in TNFD adoption into that now, as that's hot off the press, and when we launch those in November. Also in November, we'll be hosting a series of Race to Zero dialogues. So I'm looking forward to building into all of that work, everything that we're learning today and the rest of the series, and to working with you to restore nature, to make sure we have a nature positive economy, and one that delivers a resilient food system and resilient livelihoods for those who rely on nature, whether they're working in the forest economy or whether they're smallholder farmers or everyone in the value chains all around the world. So thank you for a really informative 2 days, and looking forward to the future events. Thank you, Andrew, back to you.
Nigel, thanks so much for those remarks. It's good to see you again also. And it really remains for me to say a big thank you to all our panel and all the speakers who spent so long here today, and very glad Bas could actually make contact with us so we could hear his very interesting remarks. But a number of people have asked about the TNFD and what are the next steps. So I'll tell you a bit about that. The Task Force for Nature-Related Financial Disclosure has been thought about for over the last 18 months with Global Canopy, the organization I started in Oxford some years ago, UNDP and UNEP-FI, and the World Wildlife Fund. And an informal partnership has grown. It was enshrined in the Green Finance Strategy of the UK government. We're working closely with the French government and the Netherlands, government of the Netherlands. And so we have created and launched today, or rather announced today, it's not fully launched, but this is really an announcement to say this is the direction of travel, with the idea of having an informal working group which will bring together the financial sector across banks, insurers, investors, and regulators and governments. And we already have quite a number of sign-ups to that. A number of them you've heard from today, and we will be aiming to have a more formal launch of this working group, which is really the first phase of the task force later on in September. And the plan is that the first phase should be scoping out what the task force will look like, what the team should be, what kind of framework it can develop, and how much money we need. And hopefully we are going to have some of that money arriving in early next year, and we hope to launch the research phase for developing the frameworks for the task force in the first quarter of next year. And we'll carry on through the year. Of course, there's COP26, as we've already heard, is going to have a big focus on nature in November next year. So we'll be riding that wave and going right through into 2022, by which time the frameworks will be tested and disseminated and out for public consultation. And by the end of 2022, I hope that the frameworks for nature will be ready for all to use. Will they use them? That's the big question, isn't it? If it's voluntary, probably not many. So if nobody uses them, then regulation will probably follow in the same way we've seen it happen with the TCFD. It's going to be mandatory across Europe, I suspect, in many countries over the next few years. And I think the same thing will happen with nature. So that's a very exciting trend we're seeing. We've heard a lot about how we're putting eco back into the economy. It's always been there in that word, but it's been invisible for far too long. And the tools and data, and with the help of the financial sector and companies, it's going to become much more visible in our economy in the future. So stay tuned. Thank you for staying with us for 2 hours. And there's more to come, because this is just the first two in a series of Finance for Nature global series, which is going to have a whole lot of silo breaking sessions all the way up to COP26. Future sessions will dive into issues like nature-related risk, as well as explore how we foster green investments that finance the missing middle. How do we accelerate financing for nature-based solutions? What does the nature component of nationally determined contributions look like? And what is needed to ensure their investment readiness? What's the road to COP26 for financing nature? So stay tuned in with this series. I want to thank again all our wonderful speakers for the generosity of their time and vision, and to our brilliant co-hosts, UNEP, the New York Declaration on Forests, Climate Advisors, and Global Ethical Finance Initiative. We look forward to shaping a nature